How do you recalibrate given all the turmoil of 2020 into the first 3 months of this year? How do you reset right now?
Well, I think I'm just most focused on, in my entire career, going back to 1983, Tom, my fastest growth rate I've ever experienced in a calendar year was 1984, when it was a little over 8%. I think we got a shot of taking that out this year, of having growth that's north of 8. And if we do, that's growth that we haven't seen maybe only a handful of times in the entirety of post-war history. And that is the big elephant in the room. You can talk about inflation coming up a little bit. You can talk about interest rates coming up a little bit. But if we have anything in that ballpark of growth, we're also going to have earnings which are much higher than people currently have forecasted for this year, probably more like $200 in the S&P 500. And with that, at least for this year, it's just going to be hard, I think, to keep a good equity down long term here over the course of this year, very long, if you're going to give me that type of growth. And if we're also talking like 5% growth in 2022, boy, we could have a lot of interest rate and inflation pressure and still have an equity market that could do pretty well in that environment.
So, Jim, I think that final point's the big point, 22, and whether this year ends in June and people start thinking about, hang on a minute, huge growth, we're all positioned for that now. What does 22 look like? What does 22 look like to you?
Well, I agree with that. I think, Jonathan, I'm pretty confident for this year. And if we run hard this year, let's say through the fall, we could get a big correction at some point. 2022 is going to be an adjustment year, I think, where we're going to have to figure out whether inflation's for real or not. And I'm still a little bit on the fence on that. Our policy officials have done everything they possibly could to create inflation, in my book. And we've done more than ever before to create inflation. The problem is, against that, we've got a lot of disinflationary force in the world with nasty and continued bad global demographics, including here. Yep. And also the leading force of the emerging world story, China has worse demographics than any of us. That's a pretty powerful displaced force. We've got a technology sector leading the world, which is nothing but eschews inflation or disinflation everywhere in its path, and that's going to continue overall. We've had falling monetary velocity for more than a decade, and so you could maybe handle a lot of money growth without the type of velocity we used to have. We have disinflationary mindsets in the world after 30 years of disinflation that are tough, I think, to change or alter. And I think we're going to get a pickup in productivity, because when I look back historically, when you have a big run in growth stocks over the last several years, that is followed rather regularly by a pickup in productivity. So my guess, I tilt a little that the inflation is going to be a burst coming in the next 12 months, and then it's going to calm back down again and maybe allow this recovery to continue for several more years.
Game plan time, Jim. Let's do it then. Growth's going to be better into the middle of this year. Inflation's going to pick up. The base effects kick in. We know all this. And what's amazing, I keep repeating it, take a bull, take a bear, they agree on the same thing. And at some point, you start to get that huge tug of war between the people that think it's transient and the people that think it's not, the people who think rates will rise and the people that think they won't. If you start to get volatility off the back of that tug of war, what's your game plan? How do you step into risk or step out? How do you approach that story?
Yeah. Well, I think you do a couple things. I think you want to minimize your exposure to bonds and bonds exposures, interest rate exposure. I think you just want to have that absolutely minimized. I think you want to stay more cyclically orientated here. And I think you want to be away from the United States. This is a synchronized recovery, and those markets are coming back too. But they're not going to feel, I don't think, near the pressure that we're going to get here in the United States going into 2022 from overheat pressure. So I would have a good overweight away from the United States. Now, beyond that, I think it's going to be really difficult to call this correction when it comes, but we can all try. If we really get excited here, Jonathan, and we go a lot higher, let's say we blow through 4,000, go up to 4,400 or something here, I probably would take some octane off and park it in cash for a period of time and see if we can't get a sentiment correction that could be pretty big and pretty nasty. And if we do have one of those, then maybe reevaluate that point whether I think we have a sustainable recovery going on. Part of it is more information is going to come yet.
Yeah.
If we get towards this year end and the unemployment rate, is heading towards 4% or something, I have a very different approach perhaps going into 2022 than if we get there and we're still at 5% or something. How tight are the resource markets looking as we head into that next year? So I'm going to let some of that play out, but some of this also matters about whether the market goes nuts between now and then or whether it corrects.
So, Jim, there's also a question about big tech, because if you see the longer-term trend remaining the way it has been, a low inflation, slower growth environment, is it time to buy big tech on this dip?
Well, I'm underweight big tech. I just think it's not so much I have a problem with technology. I think they're going to continue to dominate the world over the next 5-10 years. I really do. But I think their earnings growth at this point doesn't look as good as relative to what small caps can be doing right now, or cyclical sectors, or even more commodity-oriented plays. But I would still own tech, and I still do. I just have an underweighted position. If you're going to win in this market, you got to be in the broader market plays, which are more cyclical, Lisa. The problem with that is it means that you're going to introduce yourself to downside draws that could be fairly dramatic. The way to balance that is to continue to own technology. When this market pulls back on overheat concerns, I think technology holds up a little bit. And I'd much rather hold that than I would other defensive sectors.